We are looking at PepsiCo's current fundamentals straight from SEC filings. This video highlights 4 key metrics: a share price of $136.64, a market capitalization of $187.2 billion, a stock price-to-earnings ratio of 22.77, and a diluted earnings per share of $6. PepsiCo is a global leader in consumer staples, generating nearly $94 billion in annual revenue. A critical takeaway is the 37.29% return on equity, which is significantly higher than the 7.34% return on assets. This gap highlights the role of financial leverage in the company's capital structure. This chart illustrates the margin waterfall, showing how $93.9 billion in revenue compresses down to $8.24 billion in net income. Each step in this process represents a specific layer of cost, from the cost of goods sold down to the final net profit margin of 8.77%. This slide breaks down PepsiCo's balance sheet. With $112.189 billion in total assets, the company utilizes $46.351 billion in long-term debt, resulting in a debt-to-equity ratio of 2.10 times. This structure indicates that leverage is a significant factor in the company's financial profile. This summary provides key per-share data. With a current price of $136.64 and a book value per share of $16.13, the stock trades at approximately 8.47 times book value. These figures help translate the company's overall financial performance into values relevant for individual shareholders. We compare operating strength against the leverage effect here. While operating margins reflect the core business performance, the return on equity is amplified by the 2.10 times debt-to-equity ratio. Understanding this trade-off is essential for assessing the sustainability of these returns. PepsiCo is classified under the beverage industry SEC Code 2080. Its capital structure, characterized by $46.351 billion in long-term debt and a 2.10 times debt-to-equity ratio, is typical for large-cap consumer staples companies that utilize investment-grade debt to support shareholder returns. Leverage is a double-edged sword. While it magnifies returns in stable environments, it also introduces interest rate sensitivity and refinancing risk. Analysts should compare return on equity with return on assets and closely monitor interest coverage against the company's cash reserves. Here are 5 key takeaways: separate operating margins from leverage, compare returns on equity and assets, check cash-to-debt cushions, evaluate multiples against per-share fundamentals, and always anchor your data to primary sources like the SEC EDGAR filings. Finally, this slide outlines the primary sources for the data used in this video. All figures are pulled directly from SEC EDGAR's Company Facts and Submissions APIs for CIK 000077476, ensuring the data is accurate and directly sourced from official company filings.